Hello traders, this is Flirted, market analyst for City Index. Today is the 8th of May. So the markets remain on the front foot because of optimism about potential trade deals between the US and its major trading partners, starting with a deal with the UK today, set to be announced shortly. With the stocks on the rise, gold has fallen back a little bit after failing to hold above that 3,400 level once again yesterday. So let's see if it will reverse here if we get some further momentum in risk on trade. For now, it looks like a small pullback, but all the major support levels remain intact. However, that could change if the risk on sentiment improves further. So let's look at a hourly chart of the gold price to see if we're seeing anything interesting on that time frame. Well, as you can see, gold has found some resistance from this broken area of support that was taken out earlier today, and it's now being retested from underneath. So this level at 3,363 to 65 is a key area of resistance to watch on an intraday basis. And you can see that it's creating a few lower highs as well relative to its all-time high. So these are only short-term bearish technical signals on gold. The long-term chart still remains positive until and unless we see the start of a series of lower lows and lower highs. And on this time frame on the daily chart, gold is clearly still in a strong bullish trend. So for me to turn bearish on the longer term time frames, we'll probably need to see a break below this low here at 3,200 and some further bearish price action. But for now, I think the short term outlook has turned a little bit neutral following the risk rally that we've seen in equity markets. Now, looking at the global stock markets, you can see that the German DAX index is among the strongest performing markets after making a V-shaped recovery from its April lows. It's now approaching its all-time high at 23,479. Can it get there? Well, it could. It's just hanging just below that level. I think it's pausing for a breather here before potentially breaking through that area. So if and when it gets to that level, the next question is, can it hold there? Or do we go back below? If it can hold the breakout, then that's bullish, and we could well see a continuation of the rally towards 24,000, 24,500, who knows, even to the 127.2% Fibonacci extension level of the last downswing. If instead we see a rejection there, a break and a failure there, then that could potentially put the bulls in a spot of bother, in which case we could see a dip back down to 23,000 initially ahead of this longer term support area shaded in gray. US markets are not performing as well as the European markets, and the Nasdaq here is showing some hesitation just below the 200-day moving average, but the price action beneath the 200-day moving average has certainly been bullish, with the market making interim higher highs and higher lows. The key question is now, can we see a potential break above the 200-day moving average to kickstart another wave of technical buying above it? So far, it's holding firm. I think if we go above the 200-day moving average in the days ahead, we could well see the 78.6% Fibonacci level next. Although below that, we have one more potential major area of resistance to watch, this level right here, which was the low made earlier this year before breaking below it. That level comes in at 20,530-ish. But apart from that, there are no other major obvious resistance levels to watch apart from those Fibonacci levels. On the downside, yesterday's low comes in at 19,594. If we were to break below that level, I think that would be bearish, obviously, because we'll have broken down after forming a bullish signal yesterday. So in that case, we could then see a potential dip towards this area here, where previously the index had formed resistance and support. The trend line comes into play as well over there. So there's a lot of support levels on the way down, but let's see where we go from here. And a lot will now obviously depend on the outcome of trade negotiations between the US and its major trading partners. Now, in the FX space, the key market to watch for me is the Aussie dollar, because it hasn't really rallied as strongly as the other major currency pairs we've seen, like the likes of the euro dollar, the pound dollar. But the Aussie could well play catch up if the US and China trade negotiations start on a a bright note, and we see signs of a potential deal in the not too distant future. China is obviously the largest trading partner for Australia, which is why this currency pair has struggled. From a purely technical point of view, it has now broken above this area of resistance at around 63.88, and it held there for days before pushing higher in the last several days before coming back down to retest this area from above. I think there's a possibility we could well see the buyers step back in around the zone to drive the market back up to 65, possibly 66 or higher in the days ahead. However, if we get a daily close back below this support area, that would be a negative technical sign insofar as the short term is concerned, in which case we'll have to wait then for the market to ease lower once again and find support at lower levels. For more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.